Good morning or good evening, class. Whatever time it is for you, it is morning for me here and on the UNT campus. And we're going to finish up the back part of chapter 19, which is earnings per share. And I remember talking to one of my former students, oh, we're going to cover earnings per share. And she said, oh, that's going to be so easy. I remember that from 2010. Net income divided by the shares outstanding, right? And in 2010, principles of accounting, the net income was given to you, the share count was given to you. Hey, piece of cake. Now we're going to dive into a lot more nuanced details for earnings per share and how it is calculated by complex companies. And we're going to see basic earnings per share. We're going to see diluted earnings per share. Diluted and assumes everything has been converted into shares that possibly could, including share-based. We won't get into the share-based piece here, but you have convertible bonds, convertible preferred stock. And so if all of those instruments were converted, we have a larger share count, right? And so earnings per share is going to be lower under diluted. The entire financial market and everyone in every press release is focused on one thing: diluted EPS. That is considered the more real number. However, we will also calculate a basic EPS as well. One thing I would say about earnings per share, why is it so important? And I'd like you to just maybe pause and think about it. If you were here in the class, I would ask for your answer. So pause and think about, why is earnings per share so important? There's a multitude of ratios: the current ratio, return on sales, return on net assets. There's countless numbers of ratios that we talk about in accounting and even more so in the finance course. But earnings per share is the only one that is required to be listed, noted on the face of the income statement. So if you look at the income statement for large public companies with shares, you're going to get down to net income, and then you're going to show basic earnings per share and diluted earnings per share right on the income statement. Think about it on your own here. Why is it so important? Now, I wish I could hear your answers, your thoughts about this. I will have to now let you know why it's so important, because now we get the net income of the company down to a per share amount. So if a company has 1 billion shares outstanding or 100 shares outstanding, we take that earnings per share down into an individual share. And why does that matter? Because those shares are sold on the stock market, right? And so we can look and compare the price of a share of stock with the earnings per the share of the stock. And that's called a multiple in finance. It is also a very famous ratio called the price to earnings ratio, or the PE ratio. I personally will not buy a stock unless I have looked at the PE ratio and understand it. A very high price to earnings ratio means the stock is an expensive stock. That is a higher PE ratio compared to the overall stock market. And if the PE ratio is lower than the average stock market, that stock has been sold, said to list at a discount to the overall market. So whether a stock price is expensive or cheap gets into this price to earnings ratio. Stock price we know from the stock exchanges, but this earnings per share calculation is calculated by companies and disclosed on their income statement. So therefore, this calculation is critical. And if you have an error in this calculation on your income statement and you publicly announce that, that would be a significant and a material error. Sometimes companies, when they announce earnings, miss the consensus by just 1 penny. And the stock tanks. And so every penny on earnings per share really matters. Investors have a certain expectation from companies to achieve a certain earnings per share per quarter, and everyone's tracking that, following that. Companies are trying to give guidance around earnings per share, and so that's why it's so sensitive out there in the financial markets. And so this calculation is very important, and we want to make sure, and the FASB wants to make sure it's calculated in a consistent manner with significant amount of rules and requirements around how you calculate earnings per share. So we'll get into the Slideshare. These are some of the best slides that I didn't create them. They come from McGraw-Hill. So they're some of the best slides that I've worked with. And what I want you to focus on is whenever we're going to see red, and that's where there's a change. We're going to walk through an earnings per share calculation with the new introduction of a new nuance all along the way until we get to the final basic and the final diluted earnings per share calculation for this example. So watch this closely. If you cannot see these slides through the video very well on whatever technology you're using, hey, they are on Canvas. You can download them and you can look at these slides. So, and I would suggest that you do that. And obviously, this online lecture, and even if you were in the classroom, it's not enough. You got to pull the book out. You got to read the textbook. You got to be engaged to pass these exams. You're going to have to understand this material around all of this material, but especially here with earnings per share. So we have earnings available to common shareholders divided by the weighted average number of shares, right? So we may issue more shares during the accounting period. And as we know, we may buy back shares. Companies are buying back a lot of shares. And so we have to do a weighted average of the shares outstanding over the accounting period. So that's one of the nuances that we'll look at. So here we go. This is the first. Again, everything red is going to be something new. And this is the first thing we're introducing here. 60 million common shares were outstanding on January 1, and the net income was 154 million. There was a tax rate of 40%. So net income, we've already reduced those taxes, so don't worry about that. And so this is super simple. I wish it was going to be this easy for you. A business is a lot more complex as this, and so we'll have to take that into account. So it'd just be 154 million divided by 60 million shares outstanding. The earnings per share was $2.57. Remember, outstanding shares. What does that mean? From previous chapters, that is shares issued in a common stock account minus shares that we repurchase in the treasury stock account. And we only pay dividends on shares outstanding, only shares outstanding vote. So it's important that we only pick up the outstanding shares here, which has been given to you in this example. All right, nuance number one. We're just going to go through these, add something new with each slide. Here on March 1, 12 million new shares were sold. And so we had 60 million shares outstanding for the entire year, but these 12 million, they were only outstanding from March through December, 10 months. January and February, we only had 60 million shares outstanding, but then March through December, we have 72 million shares outstanding, and so we got to take that into account. And so still net income doesn't change here, 60 million shares outstanding, but now we're going to take this 12 and we're going to do a weighted average number, 10 divided by 12 to this. And so we get to 70, 154 divided by 70, $2.20 per share. So see, we had more shares outstanding for 10 months, and so we dropped from 257 before we issued the shares down to 220. So this really matters, and that's a big reduction. So, but again, we do not account for the 12 million for the whole year because they were only issued on March 1st. 10 months outstanding out of 12. Okay, stock dividends and stock splits are going to be done differently. We're going to see that because those are not really new shares to new investors. They're just new shares given to our original investors. So the people had 60 million and they're all going to get extra shares. And so we were going to have to think about it differently than we did with the new issuance of shares. And so we're going to take a look at this here. I'll just right to the next slide. So here we go. June 17th, a 10% stock dividend was distributed. And so everybody that owns 60 on June 17th, now they own 6 more, 66, right? And so we go back to the beginning of the period because these are not new investors, and for a stock dividend, we go back from the beginning of the year and assume as if, and this is only for stock splits, it was given to investors from January 1, day one. And so we multiply that 60 times 1.1. Well, guess what? This happened after March 1st. So therefore, these 12 million, they also got another 10%. So we take 1.1, that's that 10% increase on this calculation also. Again, why? Because this stock dividend happened after this. If this had happened before, we wouldn't multiply that by that. So you have to think through this and use some logic here. If you don't understand it from the lecture here, get in the textbook, figure this out, because you're going to have to understand this for the exam. And so the same thing happens with the shares that we repurchase. So we got to take into account shares that we buy back, and that's going to reduce the weighted average. And so we're going to look at the fraction of the year they were outstanding, and they're going to be subtracted. And so now back to a stock distribution. If the stock distribution happened before, then we don't need to multiply it by times 1.1. If we would multiply it, it would be increased. But if it happened after the stock split, those shares are already outstanding. When we buy shares back, that's already been taken into account. So timing matters here, and let's look at how this works. So October 1, since this was after we'd already done our 10% stock dividend, we're not going to multiply that times 1.1. We only increase those share counts and those parts of the weighted average calculation for things that happened before the stock dividend. So the stock dividend was here. This one happens afterwards, so we don't multiply it times 1.1. So let's look at the weighted average. So from October, November, and December, we had 8 million less shares outstanding, but only for 3 months, not for the full year. And we're doing a weighted average, so we're going to only take minus 8, the 8 million, and we only reduced those outstanding shares for the last 3 months of the year, not for the full year. So we're going to multiply that 8 by 3/12. And so we get into now a 75. And then because it's a weighted average, we take into effect a timing for issuance of shares and repurchases of shares. However, stock splits, we go back and as if it was at the beginning of the year, because those are not new investors. So that's the nuance here on this. And we have one last thing. Hey, keep in mind, earnings per share is earnings available to common stockholders, not preferred stockholders. So therefore, we got to think about preferred stock dividends, because if we're required to pay preferred stock dividends before we can pay dividends to our common stockholders, well, that's preferred stock dividends. They're not earnings that are available to common stockholders. They're going to be given to the preferred stockholders first. And so we are also going to subtract preferred dividends from this calculation. Notice, preferred dividends, we don't get a tax deduction for preferred dividends. And so they are not tax effective. They just come straight out, 4 million. And so we had 8% preferred stock. Remember this from the last chapter, $10 par value times 5 million shares. So we're required to pay 4 million in preferred stock dividends each year before we can pay anything to our common stockholders. So even in the basic earnings per share, we subtract preferred dividends. And we end up here, now that we've subtracted this, no effect to the shares outstanding, only subtracting preferred dividends. And so we end up here, this is the kind of the final calculation for basic earnings per share. And so we would report this $2 as our basics earnings per share. And from here, we're going to get into diluted earnings per share, which is the next calculation. So this is the final basic earnings per share. And as I said, diluted earnings per share is more important to everyone because there are a lot of complex financial instruments out there, and including share-based compensation. We're going to be large conversion of financial instruments into new shares. Therefore, the current shareholders would be diluted because there would be new ownership interests coming from things that are not outstanding today, but potentially could be outstanding. So in the dilutive calculation, we look at every one of those that potentially could be converted into shares, and we hypothetically convert them all, as if they were converted from day one in the year. And so the diluted EPS incorporates the dilutive effect of all potential common shares. Not currently actually outstanding, but they could be. They have the potential to be outstanding. So we'll look at some examples here. Options can enter the diluted increase. So we have a lot of options or warrants inside bonds, inside preferred securities, obviously share-based compensation, things that could be converted into stock. So we're just going to assume these options were exercised in our calculation. Even though they were not, we're going to assume they were converted on day one of the year. So let's take a look here. Basic EPS is $2, and this is the exercise of options. You're not going to be calculated. I'm not going to hold you accountable for this. This isn't the textbook. It's one of the excluded topics. But I will let you know if people exercise their options. If there were stock options out there, you would look at the exercise of those options and change the price. I had to include this in the slide so we could move forward. We're going to look at convertible securities. There are both convertible bonds and convertible preferred stock. You don't see convertible bonds as popular today because interest rates are so low, but in high interest rates environments, a lot of companies will issue convertible bonds. I mean, here's a bond, and they can get a lower interest rate because they're giving the bondholder an option to convert the entire bond into shares of stock. So if the stock price goes up, the bondholder has an opportunity to get more money from converting the bond into stock than just waiting to get their principal back. And so in high interest rate environments, companies will issue more convertible bonds because they can get a lower interest rate. The problem is they end up with potentially more shares outstanding, and we're going to take that potential into account. And the same thing is true with preferred dividends that can happen. So here, we're starting back, same example, and we're at a basic of $2 per share. The incentive stock options have been exercised. Again, I'm not going to hold you accountable for that, but here we go. You are accountable for this. There were convertible bonds. They didn't get converted, but they could have been converted. Therefore, we're going to take them into account in our diluted earnings per share calculation. So the facts, 10%. So these bonds pay 10% interest, $300 million face value, convertible into 12 million shares. So what do we know? It's going to be like a test back to bonds payable. What do we know about bonds? How much interest are they paying? They're paying, how much interest they pay is the 300 million times the 10%, 30 million per year. And we're not going to get in, we're not going to have discounts and premiums on this. I would love to do that on the exam, but that would be super complicated. And so we're going to assume no discount or premium on these, and that's what they do here in this example. But there's going to be $30 million of interest expense here on $300 million in bonds, convertible into 12 million common shares. So what are we going to do? We're going to convert these. Even though they're not converted, to calculate diluted earnings per share, we're going to assume they were converted. Let's look at that. And so what happens, here it is, here's the conversion. So everything in red is what's changed in this calculation. Those $300 million worth of bonds could be converted into 12 million shares of stock. So we add it back, and we add it back at 100% because we assume it was done at the beginning of the year. And guess what? If we converted these bonds at the beginning of the year, we don't have interest expense. So we get to add back. In that net income was 30 million of interest expense less the tax deduction. We remember the tax rate was 40%. So we're going to add that back as if we never had this interest. Why? We converted it day one of the year. And so we're going to add back 30 million minus the tax deduction that we would have got had we not converted. And so that feeds into this calculation. Now, let's look at the next item, convertible preferred stock. Same thing, we're gonna assume whatever instrument we have converted day one, January 1 of the year. It wasn't converted, but we're gonna hypothetically assume that it was converted in the diluted calculation. So we add back the shares, but guess what? We'd already subtracted the preferred dividends in basic. Now we want. Why? We're not paying preferred dividends because that preferred stock no longer exists hypothetically in the diluted EPS calculation. Let's look at it here. Preferred stock convertible into 3 million shares of common stock. Remember, 5 million shares at 8% preferred stock at $10. That was the $4 million of dividends that we had subtracted. Now we no longer subtract it. It was subtracted in basic, but in diluted, we're not going to subtract it anymore. Why? Convert it into 3 million common stock. So that preferred stock got converted into 3 million shares of common stock. Add it to the denominator and shares outstanding. There were no preferred dividends, hypothetically, in this diluted EPS calculation. All right, we're bringing it home, and now some things could be anti-dilutive. You do this math, and if the earnings per share is higher than basic, well, that would be anti-dilutive. So we do not account for those. We do not include. We're only looking for diluted earnings per share. So only conversions of common stock, preferred stock, or convertible bonds that would create a lower EPS. If one of those conversions creates a higher EPS, we exclude it because we're trying to show the shareholders more in diluted EPS. What's the worst case situation if everything was converted? And so things that improve it, we just exclude those. And so here, for example, here the conversion of the bonds, we had a basic EPS of $2. Remember, we calculated that. And then we look at the conversion of bonds, they got down to $1.50, less than $2. So it's diluted. We want to tell shareholders, hey, I know you're looking at $2 in basic, but if all these bonds got converted, it's only going to be $1.50. And so you got less, and so that's going to matter in your price to earnings ratio as an investor. And so you don't really care about the $2 because I know in a high stock price environment, these guys are all going to convert. And so that earnings per share is only $1.50, not $2. And so that's why personally, I know we have to do the basic EPS. I never look at it. I could care less about it. I'm looking at dilutive EPS. And here, the preferred stock got converted. We add back the $4 in preferred dividends, and we add 3 million new shares. And guess what? $1.33 is less than $2 diluted. So we include it. If this calculation, for some reason, ended up being greater than $2, we would exclude that item. We would not include it in the diluted earnings per share calculation. We're looking only for conversions that will result in diluted earnings per share. Now keep in mind, I'm not going to hold you accountable for stock options and share-based compensation because there are a lot of crazy nuances around that I had to deal with as chief accounting officer. Trust me, not a fun calculation. I reviewed that personally, and I had to sometimes have people come on, explain the rules to me again. It's that complicated. So I'm not going to hold, you can look at it in the textbook, it might be interesting to you, but keep in mind, that share-based compensation, all those executives have outstanding unvested shares. In the dilutive EPS, we bring those back in. And so and there's some special rules that we use to do that, depending on where you are in the vesting period. That's why I just did not want to hold you accountable for it. But you'll see in the real world, a lot of this dilution comes from share-based compensation, as you would probably expect. So there could be an order entry. Again, if I convert this first and then this one, oh, now this one is dilutive or anti-diluted. Well, so the order in which you do this calculation could matter, and so you have to kind of go through and try different orders to see, and you have to use the order in which these might be converted, and you got to use the worst case scenario to create your anti-dilutive. So, is dilutive effect reflected in calculated EPS? Look at all these. Not reflected in basic, stock options, restricted stock, convertible securities, contingently issued shares. We're not going to get into that. No, but they are included in diluted EPS. And so investors care about dilutive EPS. They want to know what all the shares that this company could issue if they were all converted immediately, and understand that that's diluted. So, one thing to note here, because EPS is so important, and it is, as I have said, it is included on the formal income statement for the company. For the SEC, you're required to do 3 years of income statements, and all 3 years, we're going to have EPS at the bottom. Now, I'm not sure if you've seen continued versus discontinued operations, but if you have a line item that's discontinued operations, then you need to show your basic and diluted for continuing operations, your basic and diluted for the discontinued operations, and your basic and diluted for the final net income, adding continuing and discontinued together. So you could have, potentially six earnings per share numbers on an income statement. Obviously, we're not teaching discontinued operations here in this class, and the rules are very stringent. They've actually changed in the last year or so. But what investors care about, if you've sold a large business or segment of your operations, we set that aside, and the income aside from that, so you can show investors, hey, how much is the company making from operations that are going to continue to exist? And so that's income from continuing operations. And that EPS matters because as an investor, I might not care. These discontinued operations are going to be gone in the future, so I'm not going to worry about that. So here's an example of what I just said here. So you've got continuing operations, discontinued. This is exactly how we did it at Linux. So we had our continuing operations, discontinued, and then consolidated. Here's the basic earnings per share, and here's the dilutive earnings per share. And notice the dilution, 153, only a penny of dilution here on all sides. Discontinued, there was no dilution, which I would probably see how that would be. Usually, I like to look at the change between basic and diluted to understand how many shares are out there, and if it's a very large difference, that's always interesting to me. It may be something I'd want to pursue in the footnotes to understand where is that dilution coming from? Is it coming from share-based, or they're large convertible bonds? As an investor, I might want to know more about that. And I like to talk about all of this from the investor point of view, because when we're presenting financial statements, our customers, the people that are investing in that business, I always had those people in mind as a chief accounting officer, that I got to make sure I'm providing the right information according to the rules, but also information investors care about. And that always motivated me, highly motivated me to get this right, because I knew people were counting on the accuracy here. And so that's the end of earnings per share. We will start working problems here, both on share-based compensation and earnings per share. Thank you.